Mark Matthews of Bank Julius, Baer and Co. joins us now. Hi Mark, good morning and thanks for taking the time out and joining in. Today's talking point is clearly the free fall that we've seen in all commodity plays. How worried should we be about what's happening? Glencore was down nearly 30%. Alcoa has decided to split into two companies. The news from Royal Dutch Shell is not good, as they've said they'll abandon drilling in the US. How worrying is all this?
Actually, if you look at the commodities themselves, the prices have not cratered nearly as much as the stocks. The overall commodities index is pretty much flat. So when people say commodities are falling, it's not true. But the stocks are falling, and I think what's happening is that the market is realizing that if commodity prices do stay at these low levels, then companies which have a lot of leverage will have a tough time paying off their debt.
Mark, hi, good morning. Yes, that point is taken, but you know, the worry is about a bigger financial impact that this could have, not just what's happening with commodities, but also what's happening in the auto sector with Volkswagen and their entire scam. Do you get a sense that we could see further risk aversion from global equities because of just the number of worries that continue to pile up?
Yes, I do think so. And in fact, if you look back at the markets, what we're experiencing now is not that abnormal. I would say the last 5 years have been abnormal in the sense that we had, pretty much perfect world of ultra-low interest rates and asset prices going up and low volatility. So I think we're just reverting to the way the markets have always behaved, which is more volatile. But yes, you're right. There are some things that could make it even worse than it is now. The pressures that are being felt in the commodity stocks could spread into other sectors which are also perceived to have a lot of leverage. And deflation, is definitely in several countries, and as that kind of continues to be in their asset prices, it has a negative effect too on consumption and investments. So, and the sort of Damocles which hangs above all of this is that the Fed missed a wonderful opportunity to raise rates 2 weeks ago, and now the markets are falling. People kind of wonder, can they raise rates now without making markets even worse?
Okay, so it was a missed opportunity for, by the Fed. But Mark, coming back to, the commodity issues, if the leveraged commodity stocks are in a bad shape because of the way commodity prices have fallen, will it not eventually spill over to the banking space and add to maybe the bad assets if the commodity companies are unable to pay their dues? And a more dramatic question, Sonia was just reading an article and she told me that, Glencore is now called the Lehman in the commodity space. Would that be an exaggeration or not really?
It is, how should I say, it is obviously a headline-grabbing sentence. So whoever wrote that was trying to get read, which I don't blame them. That's what people do for a living. But who am I to say whether it is or it isn't? The numbers are big. They have $51 billion in debt, and they are a commodity trading house. But I would say that, yes, the banks are the ones, that look vulnerable in this environment if this thing continues to build, and my hunch is it will. In other words, this idea that companies that have a lot of leverage are coming under increased scrutiny, whether they can pay back their debt or not.
The news flow from China doesn't seem to get any better either. I mean, we got the August industrial production numbers and they looked pretty scary. Do you foresee another leg of a sell-off because of what's happening in China?
Well, that's where actually I think the sequence of events that people think has happened is a little wrong, because I think that how should I say, the fall in Glencore's share price and other commodities share prices is not because of the Chinese industrial profits that were announced last night. Because, as I said, the commodity prices themselves have been fairly stable. they didn't go down on the back of those Chinese industrial production numbers. And indeed, I don't think the industrial production numbers were really that much of a surprise. We know that manufacturing in China is slowing down, but the service sector is actually strong there. Anyway, long-winded answer to your question. I don't think China is so much the root cause of the unease in the markets now. Ironically, if you look at the Shanghai Composite, it's one of the better performing markets over the last month. It's been flat. I think the unease, really, what the spark that ignited this fire, to go back to what I said earlier, was the Fed's failure to raise rates 2 weeks ago.
So if the Fed does decide to raise rates in, say, October or December, when it does have a chance, would it then ease the sentiment?
I'd like to think so, but unfortunately the world has changed so much in the last 2 weeks that I wonder, I think what I would like to say is two weeks ago, raising rates would have been a sign that the economy was strong, that markets could handle it, a sign of confidence. Raising rates in this kind of environment where markets are in free fall and people are worried about major companies possibly defaulting, it could actually have the opposite effect. So it is unfortunate. They've been trying to take away what they said by wheeling out all the hawks, and Miss Yellen herself last week said she is one of the ones who wants to raise rates this year. I think there's 13 out of 17 members who say they want to raise rates. But to answer your question, I think the world has changed a lot in the last 2 weeks, and maybe it's not possible after all.
Well, that point is very well taken. By the way, the markets are succumbing to some more selling pressure now. The Nifty is just hanging on to 7,700 by the skin of its teeth. And a lot of stocks are hitting fresh 52-week lows. Bharti Airtel is one of them. Just pull up the chart of Bharti Airtel. It's lost about 10% of its value this month, and it's sitting at a fresh 52-week low today. So is Tata Motors, Hindalco, and a couple of other names like Havels and JSPL as well. All of these stocks are sitting at fresh 52-week lows. So that's the kind of price erosion we've seen in the market. But Mark, I know you track the Indian economy and markets very closely as well. Today we have the big event, which is the RBI policy, and there is an expectation of a 25 basis points rate cut. But my question to you is, even if the governor cuts rates today, do you think the relief rally in the market will be short-lived, and then we'll get back to tracking the weak global cues?
Yes, I think so, unfortunately. India's a big open market. We all remember 2008. India's economy was just fine, but the stock market fell over 50% for nothing to do with India. It had everything to do with the rest of the world. So we've seen this movie before, unfortunately. And I mean, the irony is China slowing down means that India is going to have the best GDP growth in Asia next year. And commodity prices at where they are, it's wonderful for India. But whenever people get scared, they come home. And that's just something that never changes throughout the cycles in history. And many people have invested in India, and it's actually very far away from their home. They don't really know that much about it. And there's always a temptation to, as I say, to come back to the safety of your home when things look strange as they do now.
No, I didn't get that. So are you increasing your allocation to India, or are you staying away for now?
Well, we within the context of Asia, we like India more than other countries, but that's a relative thing. I think if you look at markets, with the exception of Glencore and a few of these other major companies that have collapsed, actually the liquidity has been very thin. So my concern and suspicion is the shoe has yet to drop. We need a really kind of cathartic cleansing in these markets, which I believe is yet to occur.
Which means that 2015 has already seen negative returns for most of the global equities. Hang Seng's down 13% on a YTD basis. Dow, FTSE, all of them are down close to about 10% so far this year. Do you get the sense that 2016 is also going to be a bad year for equities?
Well, that really depends on what happens between now and the end of 2015, right? I mean, if markets go down another 20%, they'll be looking very attractive indeed. And who knows what could happen? It really depends on what happens between now and the end of this year.
All right, Mark, we leave it at that. Well, that's a cautious note that we caught you on today. We hope you'll be a little more optimistic next time. But I take your point. There's only gloom and doom across the board. Lots of bad news coming in this morning. But the markets are still down almost 300 points on the Sensex. No recovery at all. We'll take a break. When we come back, we'll invite the management of Ballarpur Industries. They've sold stake in their Malaysian arm for $500 million. B. Hariharan, the Group Director of Finance at Built, will join in on the other side.
CNBC TV 18, celebrating